Hi there, this is Asoka Selvarajah of OnlineTradingRebel.com with a quick video analysis for you being done on Sunday the 12th of October 2008 following the crash in the stock markets of the preceding week. I have some interesting analysis for you, and let's go straight to the charts to see what that is. We're looking here at the Dow Jones Index with the data ending on Friday 10th of October 2008. And you can see the huge sell-off that's taken place. And a quick review of what is going on in terms of cycles. As you can see, the blue lines here are issuing forth from the 1987 crash, October 1987. And when you look at the data close up, you'll see that at each 5-year cycle, which is what these are, there was a sideways to downwards movement, in fact a downwards movement most of the time, that then was followed by a rally thereafter. And then the 20-year cycle impacted right on October 2007, which was the high. Now the top there was 4,279, which is virtually within a fraction of a, within a few percent, the 100% projection from the low of 2002, which was also, as you can see, made in October 2002. So 5-year cycle in GAN terminology, an exact 5-year cycle with a exact price relationship between the two turning points as well of 100%, i.e. a doubling of this low. Now what happened subsequently is that the market sold off and went sideways. This is a monthly chart, so you don't see it so well, but it went sideways at the 25% price projection down from this high of 14,279, and 25% price projection down gives you 10,700. The market stopped there and went sideways and then went through it in late September, and that was the start of the complete collapse within just a couple of weeks. Now when a market goes sideways through a major GAN level like that and then trades through it, it will tend to look for the next doubling of that percentage down. So in other words, 25%, we're looking at 50% as the target, which means 7,139 is the current target. So what we now see is this same thing on the weekly chart, and you see the target here of 7139, which is the 50% price projection down from the high, which not surprisingly comes in very close to the low of 2002, since the high was formed in relationship to that low via a doubling of it. Now that said, the market on Friday traded down enormously during the last week, and especially on Friday, and then had a kind of what looked like a turnaround point that could mark a bottom. And I am going to contend that it is a major bottom, and that this sell-off for now has concluded but is not yet over. The reason that it looks like a major bottom is because we have some very strong anniversary time cycles playing in here. The Friday 10th of October is in fact precisely to the day 6 years from this major low, which as we say was related to the high of October 2007. So that's an exact to the day 6-year anniversary, and it's pretty well an exact 1-year anniversary therefore from this all-time high to Friday 10th of October. The absolute date is Saturday the 11th of October, but obviously the market doesn't trade then. So Friday was the 1-year anniversary and the 6-year anniversary from that date, and of course the 21-year anniversary to the stock market crash. So we have huge time cycles impacting at that point, and so that's a strong enough reason to expect the market to make a temporary bottom and start rallying up. So if this is the case, and remember in the bigger picture we're still looking to the downside, there is a corrective bounce here, but the target is still to the downside as previously stated. So if there is going to be a bounce, then I would therefore expect it to be of a short-lived nature, namely 2 to 3 weeks in length. Now previously corrections have lasted 7 to 8 weeks, corrections against the sell-off. but now that we're in this precipitous collapse, I would expect it to be a fairly short, sharp correction. And the upside targets for that can be found by projecting from the low. The 25% value of that low comes in at 9,717, so that would be the first target and perhaps the most likely one to be hit. And the second target is the 33% projection of the price upwards, coming in at 10,364. Now, as you see, I've also included Fibonacci projections from the all-time high to the recent low, and you can see those in red, as well as from the high prior to the collapse down to the low. And you do see clustering taking place around both the 25% and the 33%. In fact, there's 3 clustering in around the 33% level. So I think it's quite realistic to expect the market, given the nature of the sell-off so far, to actually rally strongly to as high as 10,364 potentially, though it may stall earlier than that. Of course, it may not trade up at all, but my expectation is, given the cycle point that we've just been discussing, and there are other additional cycles impacting on the Friday, October 10th date as well, that there should be a bounce and the market won't head straight down to that 50% target we talked about earlier. The other thing to point out is, and the other reason why we should expect this sell-off to continue, is in comparison to previous stock market crashes. In the 1929 stock market crash, the sell-off to the first major low took 2 months and was a 50.59% decline. In 1987, the sell-off to the low was a 63% decline, which took 4 months. Now, we've been cycling over nearly 1 entire year so far in this crash, or bear market, whatever you want to call it, and we have not yet hit a 50% level. And that is quite reasonable to expect. So again, it adds weight to the notion that the market has more to do on the downside. So far, this level is about 45% down from the high. But as we said, it's extremely likely that having broken that 25% target where the market went sideways over this period, you expect a doubling of that target down to 50%, which is the 7139 level. Now, the picture therefore is a short, sharp rally, a very dramatic rally in the week to come, beginning October 13th, and maybe lasting 2 to 3 weeks, maybe lasting more, targeting either of these two, initially 9717, then 10,364, with the latter being my preference as perhaps quite a likely target, and then stalling out and resuming the collapse, again with the same aggressive vehemence as we've seen over the past week or two, and then trading down to the target I just specified. That is basically the picture, and it looks to me as if, I wish I could be optimistic, but really when we've looked at the last 2 stock market crashes, which were relatively rapid to their first lows, 2 months and 4 months in the case of 1929 and 1987, we have unfolded over 1 year. So this is like some kind of an enormous event compared to the other 2, which were enormous events of their own at the time. 1929 led to a situation where the highs were never regained until the mid-1950s. So that's like 25 years later. And after the first initial crash, the market then proceeded to trade lower and for 33 months from the high, and eventually lost 90% of its total value. Now we're looking at 45% right now, but we're looking at a kind of macro situation, so I do fear that maybe we're looking at something very, very negative here. So that's the analysis. This is Asoka Selvarajah of OnlineTradingRebel.com. I hope you enjoyed this video and have a good day.